Every time you're about to enter a trade, something inside you tightens. You see the setup, you recognize it. You've seen this pattern before, maybe dozens of times, and yet you hesitate. Your hand doesn't move as quickly as it should. Your mind doesn't stay as clear as it was just moments ago. Instead, it starts to slow down, to question, to doubt. What was once obvious suddenly feels uncertain. You begin to think more than you should. You recheck the chart. You zoom in, you zoom out. You look for one more confirmation, then another, as if certainty can be manufactured if you just look hard enough. But the more you look, the less clear it becomes. The setup hasn't changed, the market hasn't changed, but you have. And in that shift, the trade is no longer just a trade. It becomes a decision loaded with pressure. You start imagining outcomes before they happen. You see the trade going against you. You feel the loss before it exists. You remember previous mistakes, previous losses, previous moments where you were wrong. And all of that collapses into the present moment, making this single decision feel heavier than it actually is. So you wait. You delay. You tell yourself you're being careful, that you're being disciplined, but deep down, you know it's not that. Sometimes you miss the trade entirely. Price moves exactly as expected, without you. And you sit there, watching it unfold, feeling a quiet frustration, not because you didn't know what to do, but because you couldn't bring yourself to do it. Other times you enter late, chasing something that was already clear before your fear got in the way. And in both cases, the result is the same. You are no longer in control of your execution. Over time, this becomes a pattern. Every trade starts to feel heavier. Every decision starts to feel more complicated. What should be a simple process becomes something you have to mentally fight through. And the worst part is, you begin to question yourself. Not your strategy, not the market, but your ability to act. You start wondering why something so simple feels so difficult. And that's when it turns into something deeper. It's no longer just hesitation. It becomes fear. Not just fear of losing money, but fear of being wrong, fear of repeating the same mistakes, fear of realizing that despite everything you've learned, you still hesitate when it matters most. And that realization is uncomfortable because it forces you to confront something you've been avoiding. Because at that moment, it becomes clear that the problem is not what you know. It's what you feel when you have to act. There is an invisible force that quietly controls your decisions in trading, and it has nothing to do with indicators, patterns, or market conditions, and it does not come from your strategy. It comes from something much deeper, something that most traders are not even aware of. It is your need to remain consistent with what you already believe. Once you form an idea about the market, once you tell yourself that a certain setup should work, your mind begins to protect that belief. It is no longer just a thought, it becomes something you subconsciously commit to. And the moment you commit to an idea, your relationship with the next decision changes. Entering a trade is no longer a neutral act of execution. It becomes a test of whether your belief is correct, a test of whether your analysis holds up, a test of whether you are right or wrong. That is where the pressure comes from. Not from the trade itself, but from what the outcome represents. Because being wrong is not just about losing money. It is about contradiction. It is about facing the fact that something you believed, something you trusted, does not align with reality. And the human mind does not handle contradiction well. It resists it. It avoids it. It looks for ways to delay it. That is why hesitation appears. Not because you lack clarity, but because you are trying to avoid that moment of conflict. This is also why you start looking for more confirmation, even when your system is already clear. You are not improving your decision. You are protecting your belief. You are trying to reduce the chance of being wrong before you act, because once you act, the outcome becomes real. And once it becomes real, there is no more room to hide from it. Over time, this creates a subtle but powerful distortion in your behavior. You begin to act not based on what the market is offering, but based on what feels psychologically safe. You take trades that align with your existing beliefs more easily, and you hesitate on trades that challenge them. You become selective, but not in a disciplined way. Your selectivity is driven by comfort, not by probability. And that is the barrier. It is invisible, but it is always there. It sits between you and execution, shaping your decisions without you realizing it. You think you are analyzing, but you are filtering. You think you are being careful, but you are protecting. And as long as that barrier remains, you will never be fully aligned with your system, because part of you is always trying to avoid being proven wrong. This is why trading is not just about understanding the market. It is about understanding how your mind reacts when your beliefs are at risk. Because the moment your identity becomes attached to your analysis, every trade becomes heavier than it should be. And when a trade becomes heavy, hesitation is no longer an accident. It becomes inevitable. The reason you hesitate to enter a trade is not because you don't see the opportunity. And it is not because you lack a strategy. It is because entering the trade forces you to confront uncertainty in a way that feels personal. The moment you are about to click the button, everything shifts from analysis to exposure. Before that point, everything is safe. You are observing, evaluating, thinking. But the moment you act, you become involved, and involvement brings risk, not just financial, but psychological. Because once you are in the trade, there is no more distance between you and the outcome. The market will either confirm your belief or contradict it, and that is where the discomfort comes from. You are no longer dealing with a possibility, you are facing a potential reality. And if that reality goes against you, it is not just the trade that fails, it feels like your judgment failed with it. This is why hesitation appears right before execution. It is the final moment where your mind still has control over whether or not to face that uncertainty. And instead of stepping into it, your mind tries to delay it. It tells you to wait, to be more certain, to gather more information. But none of that actually improves your edge. It only serves one purpose: to postpone the moment where you might be proven wrong. You may tell yourself that you are being disciplined, that you are filtering for higher quality setups. But if you look closely, you will notice that this hesitation is not consistent. It appears more strongly after losses, when your confidence is shaken. It appears when you feel pressure to perform, when the outcome starts to matter more than it should. It appears when your previous trades are still influencing how you feel in the present moment. And that is the key point. You are not hesitating because of the current trade. You are hesitating because of the emotional residue from previous experiences. Your mind is carrying forward the memory of being wrong, the discomfort of loss, the frustration of mistakes, and it is trying to protect you from feeling that again. So instead of acting based on what is in front of you, you are reacting to what has already happened. This is why the hesitation feels so strong, even when the setup is clear. It is not about logic, it is about protection. Your mind is trying to reduce the risk of emotional pain, even if that means missing opportunities. And in doing so, it creates a new problem. You begin to trust your system less, not because it is flawed, but because you are not executing it consistently. Over time, this becomes a pattern that is difficult to break. You start associating trading with tension, with pressure, with hesitation. What should be a structured, repeatable process turns into something unstable, something that depends on how you feel in the moment. And once your execution depends on emotion, your results become unpredictable. That is why hesitation is not a small issue. It is a structural problem, because it breaks the link between your system and your actions. And once that link is broken, it does not matter how good your strategy is, because you are no longer allowing it to function as intended. If you look closely, your hesitation is not random. It shows up stronger when you already have a strong opinion about the market, when you feel more certain about what should happen. In that moment, you are no longer just observing, you are attached to an idea, and that attachment changes everything. The trade is no longer neutral. It becomes a test of your belief. If it fails, it doesn't just mean a loss, it means you were wrong. And the more confident you are, the harder it becomes to face that possibility. So instead of executing, your mind starts to protect. You hesitate, you delay, you look for more confirmation, not to improve the trade, but to avoid being proven wrong. And that's where the real problem begins. The commitment trap. The commitment trap begins the moment you form a belief and unconsciously attach yourself to it. At first, it feels harmless. You analyze the market, you come to a conclusion, you tell yourself, this should work. But the moment that thought settles in, your mind starts to treat it as something that needs to be protected. From that point on, you are no longer neutral, you are committed. And commitment changes how you process everything that comes after. Instead of seeing the market as it is, you start seeing it through the lens of your belief. Information that supports your idea feels stronger. Information that contradicts it feels weaker, less important, easier to ignore. You are no longer analyzing objectively. You are filtering selectively. This is why hesitation becomes more intense, not less. Because now, entering the trade is not just about execution, it is about putting your belief at risk. If the trade fails, your mind has to face a contradiction, and that is something it naturally resists. So instead of acting, you delay. You look for more confirmation, not because you need it, but because you want to protect your position before you even enter. You are trying to reduce the chance of being wrong, even though trading does not offer that guarantee. And this is where the real damage happens. Because the commitment trap does not only stop you from entering trades, it also affects how you manage them. Once you are in, you become even more attached. You hold losing trades longer because closing them means admitting you were wrong. You ignore signals that invalidate your setup because they threaten your original belief. You are no longer managing risk. You are defending an idea. Over time, this creates a pattern that is very difficult to break. You begin to prioritize consistency with your past thinking over alignment with current reality. You would rather stay consistent with what you said before than adapt to what is actually happening now. And that is exactly what makes this trap so dangerous. Because in trading, survival depends on your ability to change your mind quickly when the market proves you wrong. But the commitment trap does the opposite. It locks you into a position, not physically, but psychologically. And once you are locked in, you stop trading the market. You start trading your own belief. This is where a different way of thinking becomes necessary, because as long as you are trying to protect your ideas, you will always hesitate when those ideas are at risk. You don't need more confidence. You don't need more confirmation. You need the ability to step outside your own belief and see it for what it is, just a temporary assumption. This is why thinkers like Charles Darwin were so exceptional. Darwin did not try to protect his theories. He actively searched for evidence that could disprove them. He trained himself to challenge his own thinking, to question his own conclusions, and to let go of even his most valued ideas if reality did not support them. That level of objectivity is rare because it goes directly against how the human mind naturally works. We want to be consistent, we want to be right, we want to defend what we believe. But trading does not reward that kind of thinking. In trading, that level of objectivity is not optional, it is essential. Because every trade you take is not a confirmation of your belief, it is a test of it. And more importantly, it is a test of you. Not of the market, but of your ability to let go of your own bias. The real fear begins to reveal itself once you stop looking at hesitation as a technical issue and start seeing it as a psychological response. Because the fear you feel before entering a trade is not random, and it is not caused by the setup, the market, or the timing. It is coming from something much deeper, something already formed inside you before the trade even appears. It is your mind trying to protect your existing belief system. The moment you prepare to enter, you are not just placing a trade, you are putting your idea at risk. And if that idea fails, it creates a contradiction between what you believed and what actually happens. That contradiction is uncomfortable, and your mind will always try to avoid it. At its core, this fear is not about losing money. It is about avoiding the discomfort of being wrong. Because being wrong is not processed as a neutral event. It feels personal. It feels like a failure of judgment, a break in confidence, a loss of control over something you thought you understood. And this is why the fear becomes stronger over time, not weaker. Especially if you have been wrong before. Because now the hesitation is no longer about a single trade. It carries the weight of past experiences. Every previous mistake, every loss, every moment where you felt out of control, all of it becomes part of the present decision. Now, it is not just about whether this trade will work. It is about your confidence, your identity, your sense of control. And when a single decision starts to carry that much weight, hesitation is no longer a reaction. It becomes inevitable. This is where things become even more dangerous, because once the fear of being wrong becomes strong enough, your mind does not simply hesitate. It starts to protect itself in more subtle ways. Instead of confronting the possibility that your belief might be wrong, it begins to reshape how you see reality itself. You don't notice it happening because it feels logical in the moment. It feels like you are being careful, like you are refining your decision, like you are waiting for better conditions. But underneath that surface, something else is happening. You are no longer trying to see the market clearly. You are trying to reduce the discomfort that comes with uncertainty. This is exactly what Richard Feynman warned about when he said that the first principle is that you must not fool yourself, because you are the easiest person to fool. In trading, that self-deception does not look obvious. It does not feel like a mistake. It feels like reasoning. You start convincing yourself that the setup is not perfect enough, even though it meets your rules. You tell yourself the timing is slightly off, even though nothing has changed. You delay the decision, telling yourself that you are waiting for confirmation, until the opportunity disappears completely. And when you look back, it seems like the market moved without you. But that is not what happened. You didn't avoid a bad trade. You avoided discomfort. You avoided the moment where you had to face uncertainty, accept risk, and allow yourself to be wrong. And the more this pattern repeats, the more convincing it becomes. Because each time you avoid that discomfort, your mind reinforces the idea that you made the right decision by not acting. Even when the trade would have worked, the emotional relief of avoiding risk becomes stronger than the logic of following your system. That is how self-deception becomes a habit, not through obvious mistakes, but through small, reasonable decisions that slowly disconnect you from reality. Over time, this pattern does not just stay at the level of individual decisions, it evolves into something much more structured. You begin to build what can be described as a fortress of beliefs, a mental environment where your ideas feel safe, stable, and internally consistent. Inside that space, everything aligns. Your analysis feels correct, your logic feels solid, and your conclusions feel justified. The more you operate within that fortress, the more comfortable it becomes. You start to trust your perspective not because it has been tested against reality, but because it has remained consistent with itself. You reinforce your own thinking, you revisit the same ideas, and over time, your confidence begins to come from familiarity rather than accuracy. And this is where the real danger appears. Because the market does not exist inside that fortress. It exists outside of it. It does not care about your logic, your consistency, or how well your ideas fit together. It only reflects what is actually happening, not what you expect to happen. And when there is a gap between your belief and reality, the market will not adjust to you. You are the one who must adjust to it. But the fortress makes that difficult. Because the stronger your belief system becomes, the harder it is to let go of it. You begin to resist information that contradicts your view. You hesitate to act when the market does not align with your expectations. You hold on to positions longer than you should, not because the trade is still valid, but because your belief is still intact. And this is where hesitation, self-deception, and loss all connect. Because now you are no longer trading the market. You are defending a structure you built in your own mind. And as long as you remain inside that fortress, everything will feel logical. But outside of it, reality will continue to move without you. This is where the real cost begins to show, and it is not as obvious as a loss on your account. It builds quietly over time through repetition. Because hesitation is not destructive simply because you miss a trade. Missing one trade does not matter. The market will always offer another opportunity, but what matters is what hesitation does to your process. Every time you hesitate, you weaken the connection between your system and your actions. You start second-guessing rules that were once clear. You begin to question setups that you previously trusted. And slowly, without realizing it, your confidence no longer comes from your system. It becomes dependent on how you feel in the moment. This is where consistency begins to break. Because you are no longer executing the same way every time. Sometimes you follow your plan, sometimes you don't. Sometimes you trust your setup, sometimes you hesitate. And that inconsistency introduces randomness into your results, not because the market is random, but because your behavior is. Once that randomness enters your execution, your edge starts to disappear. Not because your strategy stopped working, but because you are no longer allowing it to play out. You are interrupting the process before it has a chance to prove itself over a series of trades. And this is why hesitation is so dangerous. Not because you missed one opportunity, but because you broke your own structure. You stopped trusting your system. You stopped executing consistently. And once that happens, you no longer have an edge. This is where the real shift has to happen, because everything up to this point has been leading to one conclusion. The problem is not your knowledge, it is not your strategy, and it is not your ability to analyze the market. The problem is the meaning you attach to each decision you make. Most traders believe the solution is to feel more confident, to find stronger confirmation, or to build a better system. But none of those address the core issue. Because even with a perfect strategy, if your decisions are still tied to the need to be right, your behavior will remain unstable. The solution is something much deeper. It is the ability to detach from your need to be right. This is not about ignoring outcomes, it is about redefining them. As long as you measure yourself based on whether a trade wins or loses, every decision will carry emotional weight. You will hesitate before entering, you will interfere during the trade, and you will react after the outcome. Your entire process becomes dependent on results. So the definition has to change. A correct decision is not a winning trade. A correct decision is a trade that was executed according to your system, exactly as planned, without hesitation, without adjustment, and without emotional interference. Once you adopt that definition, something begins to shift internally. The pressure starts to fade because you are no longer trying to predict the outcome. You are simply following a process. The trade is no longer a test of whether you are right. It becomes an execution of what you have already defined. And when that happens, hesitation loses its power. Because there is nothing left to protect. You are no longer defending your belief. You are executing your system. And that is the point where consistency finally becomes possible. In the end, you have to see this clearly because everything you've experienced leads back to this point. The market is not testing your intelligence. It does not care how much you know, how well you analyze, or how confident you feel about your ideas. What it is testing is something far less comfortable. It is testing your objectivity. It is testing whether you can act without needing certainty, whether you can step into a trade without trying to guarantee the outcome, without trying to remove the risk that is naturally there. It is testing whether you can accept being wrong without hesitation, without turning it into something personal, without letting it affect how you see yourself. And more than anything, it is testing whether you can operate without protecting your ego. Because that is where most traders fail. Not in their strategy, not in their knowledge, but in the moment where their belief is at risk, where their identity feels exposed, where being wrong feels heavier than it should. That is the moment where hesitation appears, and that is the moment that defines everything. Because the truth is, you don't hesitate because you don't know what to do. You hesitate because you are still trying to protect something. Something you believe about yourself. Something you want to be true. something you are not ready to let go of. And as long as that remains, every trade will carry weight, every decision will feel harder than it should, and every action will be influenced by that need to protect. But the moment you let go of that, the moment you stop needing to be right, stop needing certainty, stop tying your identity to the outcome, something changes. Execution becomes clear. Decisions become simple, and for the first time you are no longer reacting, you are operating. And that is the line most traders never cross. Because until you let go of what you are trying to protect, you will always be one click away from your own consistency.